Good evening and welcome to Money Matters. My name is Kimon, and I'm a life sciences attorney and partner at MillCrest Law in Radnor, Pennsylvania. Tonight we're continuing our series on life sciences leaders. With me as my co-host this evening is Mike Verrill. Mike is the Director of Business Development at Fesnak and Associates, a top 25 accounting firm here in the Philadelphia region. Among other things, Mike focuses on connecting life sciences companies with the professional resources that they need to develop and grow their businesses. Mike, thanks for being my co-host this evening.
Great. Thank you, Kim, and glad to be here.
I'm glad to have you. We, as you know, have a terrific guest this evening and a rather full agenda, so I think it makes sense for us to get right into the heart of our show.
Absolutely. That sounds great.
Okay. Before I introduce our special guest, however, I do want to remind our viewers that if you have a question on a life sciences matter that you would like us to answer in a future show, please feel free to send those questions to Money Matters TV, 205 East Levering Mill Road, Ballackinwood, Pennsylvania 19004, or alternatively email those questions to moneymatterstv@gmail.com. It's now with great pleasure that I introduce tonight's guest, Jim Datin. Jim is the Executive Vice President and Managing Director at Safeguard Scientifics, a provider of growth capital and operational support for entrepreneurial and innovative emerging and growth stage life sciences and technology companies. Jim leads Safeguard's deal team, which has more than 150 years of collective experience as C-suite executives, venture capitalists, investors, operators, and entrepreneurs. Safeguard targets molecular and point-of-care diagnostics, medical devices, specialty pharmaceuticals, healthcare IT, and a variety of other technology sectors. Prior to Safeguard, Jim held a variety of senior executive positions at Touchpoint Solutions, Dendrite International, GlaxoSmithKline, Isuta Holdings, and Baxter Merck. He currently is a member of the board for Safeguard's partner companies, Novosom and Putney. In addition, he's on the executive board for Celerant Consulting and the Life Science Investment Advisory Committee for Ben Franklin Technology Partners of Pennsylvania, the board for the Hepatitis B Foundation, and he's vice chairman of the board for the University Science Center in Philadelphia. Jim, welcome to the show.
Thanks, Kimon.
What first attracted you to a career in the life sciences industry?
Well, I've always had a passion for the sciences, but decided at an early age that medical school was not going to be for me. I've had a grandmother afflicted with Alzheimer's, numerous relatives pass away from heart disease and cancer, so I wanted to find a way to make some small difference in the world. 27 years ago, I started working for a pharmaceutical company, and I had no idea the changes that would be taking place in healthcare in terms of innovation or even expenditure, but I knew that healthcare was going to continue to be a growth industry that I wanted to be in.
You've held a number of senior executive positions at a very impressive list of companies that I just mentioned a few minutes ago. How did your experiences at those companies prepare you for the transition to and your responsibilities at Safeguard?
I've been fortunate in my career to have worked in many different areas of healthcare, including diagnostics, medical device, pharmaceuticals, healthcare IT, and others. I've been involved in over 50 transactions in my career, including ones of mergers and acquisitions, hostile takeovers, bankruptcies, corporate spin-outs, licensing deals, etc. I've had the opportunity to live and work in Canada, Europe, and Asia, and I've seen a lot clearly in those countries. In particular, Asia, at a recent tenure there, a lot of innovation and growth is taking place in these countries as they want to catch up to the United States. However, the United States clearly is the epicenter of innovation and where a lot of new products are coming to the marketplace. Safeguard's business model is a perfect fit for what I've done in the past because at Safeguard we look to hire and attract people who have a lot of operating experience, scars on their back, decades of experience building relationships that ultimately can help our partner companies as opposed to hiring a lot of kids out of business school that can cite a textbook or a case that they read at one point.
Sure. Were there any bumps in the road at all when you made your transition to the venture capital side?
You know, it was actually an interesting transition. There's a different nomenclature you have to get used to, and I've been used to doing a lot of transactions and deals from an acquirer standpoint or selling companies, but this is more of a long-term partnership. Typically, we're putting capital to work in companies that we're going to be working very closely with for the next 5 years. So you want to make sure you establish relationships and get on the same page with management early on. But I think a lot of the management teams that we've approached really value that operational experience and someone that can help them and provide resources to them.
With so much innovation going on out there, talk about what Safeguard's looking for in these companies. I mean, obviously you can't invest in everything. What helps you hone in on a particular company as a good investment?
Yeah, that's a great question, Mike. When I look at last year, we at Safeguard looked at over 1,000 different companies. Wow. Think about that. That's about 20 business plans coming in every week that we're evaluating. And last year we did 8 transactions. So it's a very narrow funnel when you think about it. Over 100, 150 opportunities come in. You're meeting with management teams. You're meeting some of the brightest people in the world who have brilliant ideas, and you can only pick one. In that case, 100 to 150 you're looking at. So from our perspective, it all starts with management. It has to be a top-tier management team that's been there, done it before, proven entrepreneurs. We want to make sure that the management team has to be augmented. We address it with them up front. We want to make sure that the model can further create valuation enhancement. That's not going to be a stale area. We want to make sure there's momentum. Is there wind at the company's back? Are they growing? Is it a driving force? Or potentially are they going to have some near-term challenges? We also want to make sure that they have moat. And what I mean by moat, do they have defensible barriers that they can create, whether it's in the form of IP or speed or other elements that can really create barriers to entry and allow them to succeed.
Wow, that's quite a few points in the criteria to look at. Is there a certain stage you need a company to be at to have some of those things proven, or are you willing to back and bet management teams maybe they've done it before without proving those points?
Well, for Safeguard, we like to put capital to work in revenue stage companies. So they've been there, they've started testing the market assumptions. We can do some thorough due diligence to validate, are the customers accepting this? Is there clearly growth opportunities? What we won't do is put capital to work if we're going to be beholden to a government agency like the FDA, and there's a long approval process like in biotherapeutics where it can be a decade or more of delays and incremental capital waiting for somebody to approve it. So for our sweet spot, it's where there's revenue, where we can talk to customers and we can use our significant commercial experience of launching products in the industry to validate the market assumptions.
Outside of those companies that have to go through the FDA approval process, are there situations where you might invest earlier in a company?
There are. In fact, particularly in healthcare IT or in technology areas, many of those companies can be very capital efficient. We performed several transactions recently where we put in a much smaller amount of capital up front to be able to validate the assumptions that the entrepreneurs had, spaces that we knew well, and that if it validated out, we could put further capital to work, and if for some reason we weren't convinced of the future growth, it was a small loss and we could move on. But some of those, we believe, could yield to be some very big opportunities.
That's great.
Jim, you've had a number of recent successes at Safeguard. I'm going to read these because I want to make sure I get the names of the companies right. Clariant, Avid Radiopharmaceuticals, Advanced Bio Healing, and Portico Systems. I was wondering if you could describe for our viewers, some highlights of the transactions involving one or two of those companies, and in the process, if you could focus on what first attracted you to the company, what were the critical factors that led to a successful sale, and if you're at liberty to discuss what kinds of returns that Safeguard got on their investments.
Sure. 4 great examples where we made tremendous returns in each of those. Maybe ABH would be a good place to start. Advanced Biohealing created a product that could treat diabetic foot ulcers, and unfortunately in our country with the epidemic of obesity and diabetes, it led to a flurry of amputations where people could not treat the disease. Smith & Nephew had poured hundreds of millions of dollars into building a plant and trying to build out a business to treat this. They had created a pretty unique product, but they had some flawed assumptions how they went to market, the reimbursement profile. So we and a couple of other venture capitalists had an opportunity to pay pennies on the dollar for something that several $100 million had been invested into the business. And we used our expertise to bring in a world-class management team, change the reimbursement profile, change the way that we went to market and promoted it as well. And as a result, Advanced Biohealing went from virtually zero in revenue to over $150 million 4 years later.
Wow. And
as a result, Shire Pharmaceuticals acquired Advanced Biohealing last year for $750 million. So you think about that. A product that was failed at Smith & Nephew, it was sold for pennies on the dollar, and 4 years later we're selling it for $750 million. And by the way, I might add that it was due to go public that day. 2 large banks had been hired by Advanced Biohealing, and Shire paid a 25% premium to what had been the midpoint of the IPO. Safeguard played a very active role in that in a couple of different areas. One, over 20% of the potential shareholders that were going to be investing in Advanced Biohealing, the public offering, were Safeguard shareholders that we had brought to the table there. Secondly, we had made the introduction, not the banker, to Shire Pharmaceuticals, and let the executive team there know, where we have relationships, that the tremendous asset and the upside here, along with other strategics. So we facilitated the sale, we worked with management to make it work, and as a result, we brought back our $10 million initial capital deployment, brought back over $140 million, or a 14x cash-on-cash return in just over 4 years.
Wow.
That's one example. I can certainly share others. If you want
to pick one more, that's fine. That's fine.
I'll share another quick one. So Clariant is an interesting example. Safeguard invested in Clariant in the 1990s, and it was a very different model. It was called Chromovision back then. It was kind of a spin-out for Star Wars, some of the technology applications for microscopes. It was flawed. The company never really took off. Most venture capitalists would have shut it down, but Safeguard was a majority owner in this company. So when I came on board 6 years ago, the Safeguard was in the process of just having put a new management team in place. We changed the business model. We found a way to advance the business, in particular laboratory testing, and expand it to include cancer diagnostics. And then 6 years ago, the revenue was $10 million a year, and when we sold it 2 years ago, they were doing almost $120 million in revenue. General Electric paid over $580 million for that business, which produced over $200 million returned back to Safeguard, which was one of our highest returns brought back in any time period. So you think about it, a nearly bankrupt company 6 years ago, and 5 years later we're selling it for $580 million to General Electric.
I think what's impressive about the 2 examples you gave is that it's clear that Safeguard's bringing much more than just capital to the equation. There's a lot of other things that you're doing that are really enhancing the value of the companies and enabling you to sell them for the return that you were able to get.
Kimon, that's a great point. That's what really differentiates us from other capital providers. As I mentioned, most of us have significant operational experience. We can leverage the mistakes that we've made in the past and scars on our back to be a partner with entrepreneurs and hopefully have them avoid some pitfalls. But Safeguard itself has a tremendous infrastructure of 30-plus very talented employees who have experience in operations, finance, legal, marketing, social media, a number of different areas that you think about a lot of our companies, particularly some of the younger ones who can't afford to go out and build a team of all these experts. The cost, the time frame, the distraction. A lot of these companies come to Safeguard because they see the successes that we've had. They know the infrastructure support that we can help them with, and we're incredibly referenceable, some of the highest in the industry, so they come to us and want to work with us.
When you talk about that and the competitive environment out there, has the environment for fundraising and venture capital investing, has it changed significantly over the last 5 or plus years?
It has changed, Mike. Certainly from a Safeguard perspective, first of all, Safeguard was predominantly putting capital work in technology companies in the past. When I joined and the new management team joined in 2005, we proactively said, technology has been good, but let's create a separate area in healthcare, life sciences as well. From our data and research, we found the two to be counter-cyclical. So when the bubble was up in the late 90s, healthcare was out of favor. When it crashed, healthcare became a safe place to put capital to work, and it was always a growth area. So for us, it's worked very well to have 2 separate areas, technology and healthcare or life sciences, that we could work with. And there's a great convergence in between of healthcare IT, where you have the opportunity to leverage both sides of the house in healthcare and technology. The venture capital marketplace has gone through some dramatic shifts over the last couple of years. It's expected that by the end of this year, there'll be 50% fewer venture capitalists out there today than there were in 2005. So the marketplace has declined by 50%. Safeguard is operating from a position of strength because of multiple exits that we've created, the cash that we've brought forth on our balance sheet, the debt that we've paid off. We're in a very enviable position now, not having to fundraise and having a very strong capital position that we can work from.
Interesting.
What are some? I think you touched on this in an answer you gave to an earlier question that Mike asked. But what are some of the critical components that an early stage life sciences companies needs to have in order to be able to attract investors?
That's a super question because that also has evolved a lot over the last couple of years. In the past, particularly at the biotherapeutic area, companies raised a tremendous amount of capital, and they would pursue multiple programs that became very expensive, and if they had high-profile failures, they would just move on to the next one. With far fewer venture capitalists today, you can't do that. There's not as much capital out there. So the advice that I've given entrepreneurs is you have to focus and prioritize on your most critical lead product, your most important asset. You should also be developing relationships with strategics earlier on, not waiting to the end, and trying to forge partnerships with others that you can leverage as well in this process. A great example on that, Kimon, is one of our companies called NewPath. NewPath today has 3 products in clinical trials that they could advance, but they've chose to put virtually all of their resources and time and focus on their lead product to treat migraine. And by doing so, they've got a product that should be launching next year to the marketplace that will be able to treat millions of migraine sufferers where current medications today can't do because it'll be a patch. So you feel migraine coming on, instead of taking a pill where many people have GI problems, they can't take pills, you'll put a patch on your arm, and in a quicker period of time than taking a pill, your migraine will be treated. So they said, let's get our lead product to the marketplace, and then we can address other products, such as Parkinson's and other areas, after we've got revenue and profits that we can leverage and support it.
Okay.
So given that environment, what specifically should life sciences companies be looking for to raise money? Are there other options other than this drying up venture capital market? Where else should they look for investment?
There are other options, Mike, and we're fortunate. The Philadelphia area is a great place for life science companies to flourish and do well. As Kimon mentioned, I sit on the investment committee at Ben Franklin, which is a strong institution that's been deploying millions of dollars for a decade plus in the region here. Today, they're actively looking to put capital to work in life sciences, technology companies, healthcare, IT, and clean tech companies. Actively, on a regular basis, we meet and look to meet with entrepreneurs to be able to award capital up to $700,000 that can be a great seed round investment to get companies started. I'm also the vice chairman at the Science Center here in Philadelphia. The Science Center is a tremendous place where you can get entrepreneurs together, bright people who can learn from each other in a very cost-effective environment where they can have an opportunity to gain capital, work with other talented people. One of the best examples I can think of is Abbott Radiopharmaceuticals, a former Safeguard company until we sold it to Eli Lilly recently. Abbott started at the Science Center by Dr. Dan Skavronsky. Dan decided that he wanted to get resources and a talented workforce in Philadelphia, and he couldn't find that in the suburbs or in other areas, so he based it downtown at the Science Center. Tremendous pool of talent, people that he could pull from. The company grew up and flourished, and 4 years later, Eli Lilly paid $300 million up front with the potential for up to $800 million on the back end. Eli Lilly was so impressed with Abbott and the capabilities not only of the Science Center but the Philadelphia region that as opposed to just buying the company, moving everything to Indianapolis, letting most of the people go, they've said, Abbott, we want to keep you here, and we're going to see if we can't take more space here as well to expand our footprint in Philadelphia. So here, Eli Lilly in Indianapolis that has a track record of buying companies, consolidating and moving them back, said, we're going to base part of our operation here in Philadelphia. There's other opportunities as well. Typically, Philadelphia has a very active angel investors here, a number of angels that will put capital to work. And as a reminder, angels typically will invest up to $1 million. There's a lot of angel associations here that are great. Delaware Valley Crossing is certainly one that I know of that's actively putting capital to work. There's others in the region that are actively looking for life science deals. We have 6 or 7 life science venture capital firms in the region that typically will put anywhere from $1 million to $20 million to work per company. And then there's several large private equity firms all up and down the East Coast, and many of these folks are in Philadelphia on a regular basis looking for high-growth companies that they could put 25 to hundreds of millions to work in.
Great.
Just staying on that point for a second, are there anything else that angel investors or some of the other investors in the area can bring to the table beyond just the capital? I mean, is there a mentoring component for early stage companies or things like that?
There is, Kim, and in fact, there's an organization that we've interacted with called Dream It Ventures, where there's an opportunity for companies to not only get capital, but to work with other entrepreneurs so they can be mentored. You see a lot of organizations these days trying to replicate the Safeguard model, where it's not just write you a check and good luck, you'll be on your way. The chance of success is much greater if you can surround yourself with talented entrepreneurs and mentors, as you'd find at the Science Center, places like Safeguard, and some of the angel organizations are trying to augment that they can have former executives who are now angel investors that can play mentor to a lot of these companies.
I think these last two questions sort of segues into to my next one, which I like to ask our guests. If you can talk a little bit about the biggest challenges and perhaps the biggest opportunities for the Philadelphia area in terms of sustaining a vibrant life sciences community.
Well, the life science community in Philadelphia has done well and thrived over the years. In fact, by most reports, in the top 3 to 5 in the country. The Milken report 2 years back ranked it as the #1 place in all the United States for life science opportunities and future growth. With the funding drying up, there's been some challenges to that. Companies like BioAdvance that used a lot of money from the tobacco settlement money that funded many companies that went on to achieve greatness, including Abbott in one of the early days. Now have had that capital constrained. With the cutbacks at the state level, a lot of companies like Ben Franklin are not receiving nearly as much capital. They're not able to put that to work, which is a shame because these organizations have created thousands of jobs through hundreds of companies and produced great return that's made Philadelphia be such an epicenter for a lot of life science opportunities. We've seen that shift recently from early stage life sciences to more of a healthcare IT focus here in Philadelphia, which I think can play well because we have a lot of pharmaceutical companies here, a lot of back-end service providers, and I'm convinced that Philadelphia in the next decade, along with New York, will probably be one of the top 2 or 3 places in the country for healthcare IT startups that will take place. That being said, I think we still have a lot of work to do. There's other states that are being a lot more aggressive to try to attract companies like that. I was at a recent bio organization, and nearly every state in the country had a representative there in a booth trying to meet entrepreneurs and trying to outsell other states why companies should relocate there. I'll give you a couple of quick examples. In Texas, if you have an oncology product or focus, for every $1 that's invested, they will match it with $2. If you can raise $1 million, they'll give you $2 million. And they want it to be put to work as part to advance future products in oncology. In Maryland, small companies, it's $1 per dollar match. In Minnesota, it's a free tax incentive to those angel investors that are investing, that they're not taxed on any of the gains for whatever capital they put in. So there's a lot of states trying to be very aggressive to attract a lot more entrepreneurs to their areas. I sit on the Life Science Advisory Board for the state of Pennsylvania, and we're actively meeting at this point to think, what can Pennsylvania do to be more competitive out there? And clearly a lot of it starts with some tax codes. How can we be more aggressive in attracting some of these entrepreneurs? One great example is a company recently moved from California to Pennsylvania, and that doesn't happen very often because of the tax incentives, support, and local funding that the state was willing to provide to them. So I think if we can get more competitive in the tax incentives, the funding, and some more incentives like putting people together in areas like the Science Center where they can grow and work at a very reasonable rate with other entrepreneurs, that will certainly help.
Okay. Mike, you shared with me earlier this week, and I think it's consistent with what Jim was just talking about. I guess it was an article from the Business Journal that talked about what the Advisory Council was doing and the recent report that it just issued. Did you want to review that report with?
They gave
Jim?
5 key points. I think that Pennsylvania needs to step up and act on to try to sustain and build a vibrant life sciences community here, and recognizing that funding is what it is in this recessionary period that we're in. What are a couple of the, if we don't do all 5, in your mind, what's a priority? Where do we need to start first?
I think that the first one is certainly to allocate capital from a state perspective, like the tobacco settlement funds, where there is an enormous amount of capital still to be allocated, that the state could direct that to building life science companies in the region. You think about numerous companies that were created here in the region. One great example is Cephalon, that went from 0 to thousands of employees in a very short period of time, ultimately to be acquired by Teva, also in the region. These examples, these success stories are not few and far between. They're happening every year here, where there's multiple ones creating hundreds or even thousands of new jobs. So the economics are clearly there. We have to make some tough decisions at a state level to commit those dollars there. Secondly would be the capital, the tax structure. We have to make it incentives for the investors putting capital to work and for the entrepreneurs, that they're not double taxed or that there's not disincentives to do that. It's very easy to move across the border to Maryland, where you can get matching dollars and no taxes on a lot of these investments. So clearly, I think that's going to be one of the areas as well. And then lastly would be leveraging the existing infrastructure here that's very unique in the country. You've got some pockets like Boston and Silicon Valley and San Diego where you've got other pockets, but Philadelphia, the region, has the potential to be the leader in the country, not only in life sciences, but particularly in healthcare IT. If we can take a proactive approach to start building those businesses now, I think you'll see great rewards pay off for that in the future. And let's face it, healthcare is not getting any cheaper. When I mentioned 27 years ago starting in the pharmaceutical industry, where healthcare was 4% of our gross domestic product, next year it's expected to be 16% of our gross domestic product. A decade from now, it's going to be 20%. Think about that. 1 out of every $5 spent in this country will be healthcare related. We should be at the forefront there because there's so many jobs and opportunities that can be created in our region to make us one of the premier healthcare and life science markets in the country.
Our time is really short, so I'm going to ask you a quick question. If you can give me, maybe it's not something that lends itself to a quick answer, but I'm going to ask you to do it anyhow. There are a number of pharmaceutical employees that are displaced in this region as the big pharma basically outsources their R&D groups. Do you have any recommendations to those people, the kinds of things that they can do in light of what's been going on?
You know, Kim, and I've met with several of these folks that have been displaced, and I believe there's an opportunity, because these are bright people, that the model is changing. It's moving from big pharma to biotech in some cases, specialty pharma, repurposing of other drugs. The FDA recently reviewed that they want to make it easier for repurposing of older drugs, what's called 505(b)(2)s. And what that means is that you take an older existing drug that had been approved for a certain application, you introduce it for a new one. We think there's going to be tremendous opportunities for that in the future. And I think a lot of these talented R&D executives, if we can give them the right resources and support center, could be very successful to help create companies of tomorrow.
Okay. Well, I think that's about all the time we have. So I want to thank our special guest, Jim Datin, tonight. Jim, you were terrific. Appreciate having you on. Love to have you back another time.
Thanks, Kimon.
Mike, thank you for being a great co-host this evening. I really appreciate it. The next guest on the next episode of Money Matters is Todd Westby, who's from Newmark Mac Realty. I want to thank everybody for watching this evening, and we'll see you again next time.